All right. Thanks again to everybody for joining us for our presentation today with Vlad Karpel. Vlad is the founder and chief investment officer at YellowTunnel. YellowTunnel's research and forecasting platform uses advanced neural networks to make even the most sophisticated trades easy and simple to execute. Self-directed investors use this institutional-grade technology to find and manage high-quality, high-return trade opportunities. YellowTunnel is a community of resources to help traders conquer the mental and emotional aspects of trading for positive gain. You can access coaching, webinars, forums, articles, and other tools not found anywhere else. Now, prior to TradeSpoon, Vlad was an executive vice president and head of technology at Options Express. From the company's incentive through 2007, he was doing that. During his tenure, the trading platform developed under his leadership, and it handled 300,000 plus customers, processed more than 60,000 trade orders daily, and powered the company's growth to over $1.6 billion in market capitalization. Vlad has also served as CTO of MediaOcean and as a consultant to an investor in early-stage financial tech companies. He has been building and optimizing the core TradeSpoon algorithm for more than 15 years. So Vlad has a very, very impressive background here. And as a note here on your screen, you've been seeing our Option Hotline webinar disclaimer. Please be sure to check out optionhotline.com and click on the disclaimer link to see the full disclaimer. And with that, Vlad, if you are ready, I will hand over controls.
Thank you. I'm ready. Just let me know if the audio works and if the video.
Yep, I can hear you loud and clear, Vlad. That's great. I can see you. That's great. If you want to share your screen and take over control, you'll be in good shape. If you guys have questions during the presentation, please throw those in the Q&A box. You can also email us at support@optionhotline.com, and I'll be sure to direct those to Vlad if you have a question that comes up afterwards.
I'm not sure if you need to give me permissions to share screen because I used to see. Ah, now I see it.
Yes, okay. Should be good. Let me know if you're having any issues on that.
It appeared and now it disappeared again. Hold on.
Oh, no. The joys of technology at times here. I'm sorry about this.
Sorry, I'm like using two screens. And
if I stop my share, that might be enough to let you go in here.
Yeah. Yeah. I think so. Yep. Now I see it. Perfect. Desktop 1, share screen.
All right. I see your presentation, Vlad. Looks great. So I will mute myself and let you take it away.
All right. How's everybody doing? First of all, wanted to say thank you to Options Hotline and Keith specifically for inviting me for this presentation. I'm super excited. This is my first presentation. Hopefully you guys will enjoy it and we'll have many more. So today I'm going to talk about key trading metrics, return on capital, probability of success, and estimated move. And the most important from my perspective is that obviously it's geared, we're an options hotline, so the word options implying that we're going to talk about options, but I think even if you're a stock trader, it is very important to know about these three concepts: estimated move analysis, probability of success, and return of capital, because it can show you a trend, but more importantly, it can show you support and resistance levels. And whether you're a stock or option trader, very important. Also, we're going to spend 30 minutes on the presentation and then open up Q&A for the following 15 minutes. So try to stay at the end. Hopefully nobody's going to fall asleep. There will be a special bonus towards the end of the presentation. Yeah, and if you have any questions, please be sure to type questions in the chat. I always want to make sure that we get a chance to reply to your questions. All right, so thank you for the introduction, Keith. Just to reiterate, I've been trading for over 25 years. The difference between YellowTunnel, maybe some of the other services, that my background is technology, right? I have a master's degree in computer science, specializing in artificial intelligence. I actually wrote artificial intelligence paper 25 years ago, more than that. And I was a CTO of Options Express and several other fintech companies here in Chicago. And when Options Express went public and I decided to manage my own money, I used all of that experience working with developers, financial engineers, building models, neural networks to generate signals to help me trade. And then that's the inception of YellowTunnel. I've been doing that for over 25 years, basically building technology But unlike other services, I actually trade these technology on a daily basis in live trading, right? We have a opening session and closing session. So that's my background. Disclosures are important. I'm going to go through specific trade ideas, right? Theory is great. Estimated move analysis, strike selection. These are all great examples, but how do I apply this in real life? So I'm going to go to specific trade ideas and some of the actually trades that I executed today. So it's important, if you're new to trading stock or options, to visit this link, optionsscreening.com, so you can understand the risk associated with trading stock or options. I'm not a financial advisor. I'm here to basically for educational purposes only. Please, I'm not registered with FINRA and SEC. Standard disclosures, but they're important. So please, you can always pause the screen if you need more time for the disclosures. So before we jump into estimated move, again, I want to zoom out and, from my experience, there's 7 pillars of consistent trading where you want to be profitable. Everybody wants to be profitable, disciplined, and consistent trading, right? The kind of mechanical where I can write it down, give it to someone else, my trading plan, my rules, and they can execute it on my behalf. Kind of repetitive process, consistent. So one is you need to choose what to trade, right? Products and sectors. Do you trade silver? Do you trade futures? Do you trade options and futures? Bitcoin, something that you're comfortable with. And a lot of it will depend on your background and risk aversion, right? Position management, opening and closing positions are very important. At what level? And hopefully today's presentations will help you determine how to open and close positions. Avoid chasing the market. Don't pile into established trend, especially towards the end. We're going to talk a lot about probability of success and return on capital. There's 2 thoughts on this subject, right? You can structure your trade where you have high probability of success. Usually that's followed with a small return on capital on some of the selling strategies, like iron condor, selling out of the money premium, right? Or you can have large return on capital, but smaller probability of success. And these are usually when you want to be long volatility, debit spreads, buying puts, buying other than my calls, butterflies, debit spreads. Risk management is important. Whether you're stock or option trader, you want to be long and short the market at the same time. We had CPI data, PPI data. Tomorrow, CPI came in better than expected. Last time I checked, Powell didn't say anything negative. He did pencil in 1 rate cuts. Rates dropped, market rally, but tomorrow is PPI data. And if it comes in harder than expected, then 1 data point is not enough. We had January, February, and March where CPI data was trending up. It will take at least 3 data points to show that the passive least resistance for inflation is to the downside. Trading psychology, option YellowTunnel. A lot of people ask me, what is YellowTunnel? The YellowTunnel, the idea is that we have a lot of content on trading psychology. We have clinical psychologist who's a trader who comes in once a week and talks about very important topic. To me, the 2 fundamental concepts of trading when it comes to trading psychology is game theory. We're going to talk about game theory and positioning, right? Dealer positioning is important, whether it's futures data, options data, equity data, but you want to know how everybody else is positioned. What Vlad thinks is very, Vlad's not going to move the market, right? But positioning, a dealer's positioning, it will move the market, right? So it's important to analyze that. We're going to talk about VANA, we're going to talk about gamma exposure, and trading plan, find the rules and stick with them, right? So that's kind of high level, if you zoom out, important concepts. Trading is based on probability of success, right? It's the probabilities. Whether you start on option traders, right? There's no 100% certainty, right? Certain events, like I'm going to talk about Oracle earnings, right? Oracle earnings yesterday. If you look at the presentation, I said there is a 1 standard deviation in Oracle. Maybe it can move, 5 to 6%, or there's 2 standard deviation move, right? Where it can move 7 to 15%. The 2 standard deviation move occurs a lot less often, right? You see this bell-shaped curve. So I encourage you to start thinking about trading in terms of probabilities of outcome. These probabilities, 1 standard deviation and 2 standard deviation, mathematically, historically, happen, 1 standard deviation, 67%, roughly 2 standard deviation, roughly 98%. But there's certain patterns in the market where these probabilities are elevated, right? And you can detect them on futures data, options data. You can see stocks like that are driven by AI theme, NVIDIA, Broadcom tomorrow, Oracle today, CRM last week, CrowdStrike. There are probabilities of 1 or 2 standard deviation move is significantly higher than historically, right? And that's the pattern where you have to make a decision. Do you want to be long the volatility or do you want to be short the volatility? And be sure to type in your questions. I want to make sure that I address them. So that's probabilities of event, right? And if you haven't thought about a probability of success, I encourage you to look at, just think about it when you roll 2 dice, right? When you roll 2 dice, you know that 7 will come out more often than not, here 17% of the time. 6, 7, and 8 will come out, 14% plus 16 plus 14, okay, roughly a little bit less than 50% of the time, right? So you can basically say, I think most of the time it's going to be 6, 7, and 8. Very rarely is it going to be 2 or 3. And then you can basically decide. Stock market works the same way, right? If Oracle yesterday was trading at 130, you have probability, the fact that it moves 12%, probability is less than it moves only 1 standard deviation. We have AI forecast toolbox, right, where you can actually look at the trend analysis and direction on the website. So we'll go over that as well. One of the first decisions as a trader, especially when you start trading, right, you're going to have these concepts. Usually you start trading and you're buying calls, right? And, GameStop is back, right? Roaring Kitty, right? Gail, great movie, right? I think if you're trading stock and options, you want to talk about, learn some of the concepts like game theory, risk aversion, right? Risk aversion are the pillars of trading psychology. And you want to see, the movie Dumb Money that talks about GameStop, right? So when you're new to trading, usually you buy calls. This is the first thing you learn, that the calls are bullish. It's kind of, if the stock is going to move a lot, you buy calls, right? And you always buy calls no matter what, right? And that's great, right? That's how you learn. But that is assuming that volatility is going to expand, right? If volatility is going to contract, right, then you need to sell premium, right? Because at some point, GameStop in 2 days goes from $20 to $80, but then in a matter of hours, it goes from $80 to $40. So looking at these gamma and gamma squeeze and positioning is very important. And it's something you want to start thinking about. Do I want to be long volatility? Do I want to be short volatility? And the answer is, it's your opinion on volatility. What is the volatility? It's a complicated concept. I always think about, you have this definition, realized volatility of financial instruments, or generally measure, calculate by determine average deviation from average price. So historical volatility, you look at the Bollinger Band, right? They can give you 1 standard deviation too, but based on historical data, how much is the stock expected to move, right? When VIX is at 13, market is not going to move more than 1%. When VIX is at 20, 25, market is going to move 2%, right? So based on the volatility, you can see how much the stock is expected to move historically. Implied volatility is determined by supply and demand for options data, right? So if you can look at the options data at the money calls and puts, apply, Bollinger binomial equation or, Black-Scholes model, different models, you can determine what the implied volatility is. But that's future, right? If you're doing earnings, if you look at the weekly options that expires on Friday, it will tell you what the expected volatility is. Broadcom announcing earnings after the close, there is expected volatility move. So what usually the most important decision, do you sell options or do you buy options? And you want to look at the implied volatility versus historical volatility. Oracle had earnings last night. Implied volatility is at a peak before the earnings. After earnings, once the uncertainty decreases, implied volatility drops. So when implied volatility is a lot higher than historically, usually you sell premium, right? And when it drops to the low level, right, to these troughs, then that's when you want to buy volatility. During earnings, you have to be careful, just because you think that volatility is going to drop on Oracle, but, it might expand, especially if you have positive surprise, 2 standard deviation move, and the stock, and then you want to be long. So implied versus historical volatility is important, right? So then positioning, so gamma exposure and VANA. These are complicated concepts. I'm not going to spend too much time, but the idea is that these spikes that you see in the graph in gamma or Vanna, right? This is a single derivative, second derivative. When I hear these concepts, I think about my calculus classes in high school and college. I have shivers. You don't need to know what think of one derivative as velocity, right? How quickly you're driving. And think of Vanna as acceleration, right? First derivative, second derivative. So gamma, think of it as, velocity, how quickly stock is moving, and Vanna think about as, is it accelerating during the earnings? But what's more important is these spikes, right? High open interest, gamma exposure, Vanna exposure basically shows at which strike levels there is a high demand, right? And yesterday, if you looked at Oracle, this is actually a screen of Oracle trades, you would see biggest position across all the expiration months were at 140, right? So if you think this is AI stock and it can move to 140 because this is where the highest open interest is across all the weeklies and monthly expiration, then you can create these asymmetric structures, right? You can be long volatility. You can decide, this is AI play, just like CRM or just like HPQ. It's either going to hit a home run or it's going to get, strikeout, right? CRM got strikeout, HPQ got home run, Oracle got a home run, right? 2 standard deviation move that supposedly should only happen 2% of the time, but not when there is a high demand for these out of the money calls or people selling out of the money puts, right? So you look at the weighted, fixed strike volatility, you do weighted average, and in this graph, it basically shows you weeklies, you do have call skew, right? People want to buy calls a lot more, but below 0.50 and buy puts. So when you buy puts and sell calls, the weighted volatility is above 0.5. When it's below, and you see these large open interest, the large Vanna below, negative, that means people are selling puts, right? They're selling puts and they do risk reversal to buy the stock, right? So 2 scenarios usually have, again, it's a game of probabilities, right? You structure probabilities. You don't know if it's going to hit 140, but if there is a positive surprise and they have $10 billion worth of backlog of the demand, despite that they missed on top and bottom line, the stock did actually move surprisingly to 140. So open interest, right, helps you determine strike price, or it helps you determine where is support and resistance level. So if you do have a stock, maybe you want to sell 140 calls before the earnings, do a cover call, do mirrored puts, or hedge your portfolio. So in trading, there is no magic, right? You either structure your trade where you have high probability of success, like Oracle trade, you buy calls or you buy butterflies, but high probability of success is selling premium, right? You sell out of the money premium, delta 20, delta 15, you have very high probability of success. Delta is usually a good proxy for probability of stock reaching that level between now and expiration. So you have high probability of success, low return on capital. These are your credit strategies, right? If you want to take advantage of high volatility, that the volatility is going to collapse. Low probability of success are strategies where you are buying calls, right? Buying calls, very low probability of success. 70% of out of the money options expire worthless, so 90%. Depends how you structure your trade. But sometimes, based on the unusual options activity or during earnings, you can create these low probability of success, but high return on capital. That usually you long vol, right? You long volatility and you're buying. So this is an example when low probability of success, usually you buying debit strategies, and high probability of success, usually selling, out of the money premium. Return on capital is very important, right? So this is a profit and loss diagram of call spreads, right? This is a bullish call spread. So if you want to structure a trade on Oracle and calls are expensive because implied volatility is that high, prior to this, you can offset some of the premium with buying, let's say, 100 call and selling 105 call. The advantage of call spreads is that you have limited upside, limited downside, but if you choose your select, if you look at the select strike prices like Oracle 140, you don't think it's going to go above 140, then you do a debit call strategy. You can always do two. You can do a call spread plus bullish call spread. You can add a bearish call spread. And then you either have a butterfly if it's the same strike price or a condor if it's a different strike price. But all of these long vol strategy allows you to express your bullish bias and to say that the stock is going to trade in certain range. Debit spreads, premium is higher than the butterflies, condors, call condors would be premium higher than, debit spread, and so on and so forth. But we'll start with two-legged strategy, right? If you understand what the call is, right, it's the right to buy a stock at a certain price, right? If the stock is at 80 and you buy it at 100, then you're expressing your bullish opinion. So the debit spread, right, it's the difference between the maximum loss, right? So return on capital is basically the premium that you're paying, the premiums that you're paying. So I actually wanted to show you I did two trades. I did HPE calendar spread and I did Oracle debit spread, right? So yesterday I did 135, 140, 145 call spread. Selected 140 strike because of the large position. The highest position was at 140 call. If you look at the estimated move analysis, right, the estimated move analysis that I will show you shortly, it's basically projected 10 to 12% move in Oracle, right? And if you look at the Oracle, it moved exactly, it was higher, but it closed exactly 140, right? Before I remember doing these presentations, 10 years ago, I thought this is miracle, right? Like, how can you know yesterday that it's going to be, at 140, right? Why? Well, the answer is positioning, right? The answer is positioning that helps you with the strike price selection. If you look at this chart yesterday, 140, if you look at my presentation yesterday when I did this webinar, 140 was the highest open interest. And I do see that there is a put skew, especially in the monthly options. And a lot of people were selling out of the money put. And so that means that this high open interest can act, sometimes it acts as the repellent, but sometimes it acts as a magnet, right? And same thing happened actually HPE. I did the calendar spread last week and this week. And if you look today, HPE almost acts as a magnet, right? It actually gravitated to 21. It got to 21 on the earnings. I sold the week option that expired last week, and then I bought the option that expired this week. In both cases, the advantages of these calendar spreads or advantages of debit spreads or butterflies, your long volatility, you think the market is going to move, but you're risking very little. Right. In this example, I spent 36 on the call spread. I didn't know if it's going to move up or down. Right. That's very hard. It just depends on earnings. I actually have friends that are market makers and they say, no, you can look at the signature. You can predict that CRM is going to drop. Maybe. I don't know how to do that. It's the odds, right? Nobody knows for sure, but the odds sometimes favor that CRM is going to sell off on the earnings. Since I don't know that for sure, and I kind of, I'm frugal by nature, but I decided I'm going to do both. But still, I spent 47 cents and 36 cents on Oracle put spread and Oracle call spread, 80 cents, and I was able to close for $1.70. So overnight, triple-digit returns. You're not supposed to advertise triple-digit return, it's frowned upon. And I'm not going to say that every trade is triple-digit return. In HPE, it was 25 cents, and I think I spent, let's see, I think I spent 14 cents on HPE. Yeah, so I spent, same thing, I bought a puts, not same thing, I did the debit, I did calendar spreads that expires, same strike price, but it expires on different weeks because 21 is acting as a magnet, right? It's acting as a magnet because that's where the highest open interest is. And 14 cents was able to close it for 25 cents, right? Does it happen all the time? No. Is the probability elevated where it's more than just 2% of the time? Then the answer is yes, right? So that's very important when it comes to gamma exposure and that, probability of success and return on capital. So this is how you can calculate return on capital and relationship between probability of success, return on capital, and implied volatility. The next one is estimated move analysis. There's different formulas. I usually have, I like to do things very quickly. So if you want to know 2 standard deviation move on Oracle, if you look at my presentation yesterday, all I do is at the money straddle, right? At the money where the stock is trading, I take puts and calls, ask of the put, ask of the call, add it together. I do out of the money strangle, sell, bid of the put, bid of the call, add it all together, divided by 2, and this is how I know the estimated move analysis. And yesterday it was exactly at 140. So the estimated move analysis for Oracle implied the move to 140 and the positioning, right? This is not a magic. I'm not the only one who knows about estimated move analysis. So you saw the largest concentration was at 140, right? Because people wanted to be a GameStop, right? They wanted to buy these out of the money calls and make a triple-digit returns. If you just buy and calls, sometimes market makers know exactly what you're doing, right? And they're gonna price these options accordingly, and then you have to be correct, and you have to outsmart the entire, everyone. Here, you're risking less, right? But if it does move in your direction, then you can have these asymmetrical returns that, if you read Black Swan Events or Anti-Fragile by Nassim Taleb, right? He talks about asymmetrical return, bell-shaped distribution, right? Where you keep 80% of your money not in riskier assets, but 20% of your money, you try to find these asymmetrical returns. I think he was buying out of the money puts, was the idea that at some point market will collapse, and it did. Or you can, buy butterflies on Oracle, and was the idea that the stock is going to move to standard deviation. So great books. I encourage you to read it. I encourage you to read books also on the estimated on the prospect theory. Right? The idea of prospect theory is that, which is very important, that there's also asymmetrical, not only you can have asymmetrical returns, right, when you long or short the volatility, but we have asymmetrical feelings, right? The way we feel about our gains and about our losses are different, right? And that applies to 9 out of 10 people. So knowing these, you can read more on our website, but knowing about these concepts that, our relationship with money when it comes to gains and losses are different, right? When you make 100, when you're confronted with a choice to make, let's say, in the wiki, if you look at the, he got Nobel Prize for this, Daniel Kahneman. He got Nobel Prize for this. This is part of, every, I have 2 daughters in Champaign that study finance. Everybody studied this utility theory and prospect theory, the idea of loss aversion, the idea that, you have 2 scenarios, right? The saying is that you look at your losses, you let your losses, you want to cut your losses, right? And let your winners run. But we're always doing the opposite, right? We let our losses run and we cut our gains short, right? We don't know about this instinctively, but these are guys that got Nobel Prize and wrote a lot of papers. So knowing about these concepts, game theory, prospect theory, are very important. And just if you have 100% chance to make $450, right? You always take a 50 chance to lose $500. You always take $450, right? It's the gain. You lock it up, and then you're good. If you're confronted with the 500 loss or 50% chance of losing, $500, you do the opposite. You always try to avoid the losses, right? Because the feeling is much stronger. So you end up with the sometimes $1,100 loss. And then even if you're right 70% of the time, right? Going back to probabilities of success and return on capital, you need to be correct more than 75% of the time, because if one time you lost $1,000, but 2 times you made $500, well, you're just spinning your wheels, right? So very important concept. Those are the foundations of successful trading. I know, let's open it up to questions, but before we get to questions, if you want to know more about how to structure your trades using option spreads, or participate in the earnings, you can go to YellowTunnel.com/EPT, right? And you can sign up for earnings power trader service, right? So I'll leave it here. We do have introductory prices, so you can actually, it's not a lot. So just to try it out, you can try it for $97 for 3 months, right? And then it gets rebuilt 147 every 3 months. We have, also aggressive power trader. You can take that. I like aggressive power trade because this is a neural network model that provides signals. I traded CrowdStrike was yesterday, right? Today is INCY. And you also have this AI analysis, right? You can type in NVIDIA and you have basically, you can click on AI analyze and it gives you trend analysis, support and resistance levels, right? It basically said today, buy NVIDIA at 120, at 131, you probably want to sell. And long term, the trend is higher, right? So that would be my proposal. So yes, yellowtunnel.com/EPT. There is a getting started guide at the end. I will email you guys, hopefully either today or tomorrow, the getting started guide. But for now, try yellowtunnel.com/EPT. It's risk-free. If you try it for 30 days, you don't like it, we don't ask questions, ask for refund, no problem. Any questions?
Thank you, Vlad, for your great presentation. We did have a few questions that came in during the presentation. From early on, you started to talk about interest rates, which is, of course, very relevant today in particular. What's your current outlook on the interest rates and market direction?
Thank you for this question. So my view, it's a pattern of lower highs and lower lows, right? After the CPI data today and tomorrow into PPI data, we broke through this main, the main support level, right? 4.3. You have to go back to October of 22, right? Support and resistance levels defined by short-term, medium-term, and long-term, right? If something is long-term, it's very hard to break it, right? And if it's something that happened only 2 days, then it's very easy to break it. This support, everybody talks about 4.3, almost like a magic number. We've been dancing, interest rates have been dancing around this level for quite some time. You still see it's in downtrend, right? And it dipped below 4.3 today. We have PPI data tomorrow. If it comes in harder than expected, you're probably going to have a reverse reaction. But if it's not, then but still, for the past, since April, it's the pattern of lower highs, lower lows. Since October of 23, it's a pattern of lower highs and lower lows. So I think the trend, the inflation is subsiding, and the passive least resistance is for inflation to continue going lower.
Interesting. So if, for your opinion, then if interest rates were to start to rise back up and use that support level of 4.3% again, after all, what does that imply to you for market direction? Are we thinking more chop, or can it continue a bull trend?
I think the bull trend, my opinion, that as long as we're below this 4.7 level, as long as we're below 4.7 level, we're trading in the range, then the bull market continues. It's a pattern of higher highs and higher lows. And right now, spiders, I think 70 or 75% correlated, historically high correlation between bond market and equity market. And I think bond market is what drives the equity market, except maybe NVIDIA. Right, NVIDIA is on its own, but even NVIDIA or Bitcoin, you can see risk on or risk off trade. Usually, risk on trade happens when interest rates drop. So I think, so that's my opinion, that as long as we don't have, 3 or 4 months of higher than expected inflation data, interest rates should be below 4.7, and then it's a pattern of higher highs and higher lows. Thank you for the question.
Yeah, no, that's great. Now, changing the tune a little bit here, what do you do for selecting strike price for an option strategy? How do you select those strikes?
Right. So thank you for asking that. In example of Oracle, I just want to kind of go back to that screen. I looked at open interest. There's a lot of sites where you can look at open interest. Try to find, the one that aggregates open interest, right? You have like a gamma exposure. Gamma exposure, you type in gamma exposure. Everybody has gamma exposure tab. Do you need to understand what gamma is? Maybe not, especially if you're a stock trader, but where the spikes are in high open interest are very important to understand, right? This is where 140 yesterday, there was the largest spike at 140. So concentration of happy open interest across all expiration months in that fixed vol for that strike price is what can help you determine strike price selection. Whether you're doing earnings trading or right now you want to see, if you look at gamma exposure, VANA exposure for spiders going into July earnings, you can see very high concentration of call selling, right, in 545, 550. So I don't think we're going to, we might have another 2% up going into earnings season, but probably the VANA is going to start working at 550. So as you get closer to 550, this is where you might want to think about either hedging, maybe trimming some of your long position if you're trading stock only, or maybe it makes sense to sell calls. Thank you for the question.
Yeah, that's great. Thank you. And I wanted to point out, I really like that visual representation of what gamma and VANA are for people that didn't catch it. So if you think of delta as the direction you're going, gamma, how fast you're going there, and VANA, how fast you're accelerating. That's a great way to visualize how this market can move and why these Greeks are important, the second and third order Greeks. So thank you for that visualization there, Vlad. I have one other question here, and that's, what is the relationship between the return on capital and the probability of success?
So thank you for that question again. I think that's what trading is all about, right? Some people think that you can have triple-digit returns every time, right? And you participate. If you watch the movie about GameStop, Dumb Money, it basically talks about. But in reality, once you realize that trading is all about probability of success, it's all about return on capital and estimated move analysis, right? Kind of a bell-shaped distribution curve, which we kind of touch base in high school. Then you realize this is a probability of certain outcomes, and you basically invest in money based on these probabilities. You will also learn as you get experience that sometimes there's an elevated probability of success, but in reality, you either can in the beginning when you trade in calls, which is also fine. I think when you learn, you want to trade calls first, but in reality, you always want to have this image in your mind, right? You're either going to learn how to have high based on your personality, right? We all have a different path of trading. We all have different experience, and we all have different risk aversion or risk tolerance. So, I like to do, lower probability of success, higher return on capital, right? If you like to take a lot of risk, but at some point during market condition, you realize that most of your trades are not successful. So you gravitated toward higher probability of success with lower return on capital. But you can't have both. You cannot a retail investor unless you have some kind of technological edge. You cannot have high probability of success and high return on capital, right? That usually does not happen for retail investors. So you want to kind of decide, am I long the volatility? Am I short volatility? What the game theory, basically another concept in addition to prospect theory, I encourage you to start thinking about game theory and what that is about. That there is no right or wrong answer, right? The idea of game theory that you need to be, sometimes you want to be long the volatility, sometimes you want to be short the volatility, right? You never want to be always in the same square, right? Sometimes you're in this square, sometimes you're in this square, and you look at market conditions, you look at implied volatility, historical volatility, and then you make that decision.
That's absolutely crucial. I think you're right. Being nimble with the market is an important thing. And if you're only comfortable with either long or short, to me, I think that one of the things people have to recognize is it means that not all market conditions are going to allow them to trade. And that's fine too, I guess, for some people. Expanding your comfort zone is great. But if it's not in your comfort zone, it's probably sometimes better for your own psyche not to force something, I guess, right?
Yes, for sure.
All right, so I think we're bumping into our time here, which I really appreciate you coming on again, Vlad. If other questions arise, feel free to throw those over to support@optionhotline.com. I will make sure that they get directed over to Vlad, and he can follow up with you. Take a look at that link he's got on the screen right now, yellowtunnel.com/EPT. I also put it in the chat box so you can click it directly. Thank you again, Vlad. I'm sure we're going to have you on again. This was a great presentation, and I really appreciate you taking the time. And for those of you that attended, thank you for taking the time as well.
Thank you, guys. I appreciate the opportunity, Keith, and everybody at Options Hotline. Thank you very much.
Great. Everybody have a great evening. We'll talk soon.
Yeah, bye-bye.